Imagine it is the 4th of December 2001. You are a 43-year-old civil engineer living in Buenos Aires, Argentina. Your apartment on Avenida Corrientes is modest but paid for. You have spent 20 years building your savings, roughly $40,000, converted into pesos and held in a local bank, just as the government told you to do. Your daughter is 16. She wants to study medicine. You have been quietly setting money aside for her tuition for 3 years. You eat dinner each night at the same table, watch the same nightly news, and the anchors keep telling you that the economy is stable, that the peso is strong, that the government has everything under control. You believe them. Why wouldn't you? The numbers on your bank statement look exactly the same as they did last month. If you have ever looked at the news and felt a quiet, nagging sense that something is wrong, that things feel fine on the surface, but something underneath is shifting, stay with me. What you're about to hear is not a theory, it is a pattern. It is repeated across different countries, different languages, different centuries, and it always moves in the same direction. The warning signs were there in Buenos Aires, they were there in Weimar Germany, they were there in Japan in the 1980s and in the United States in 2006. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. Because 8 days after that quiet dinner in Buenos Aires on the 12th of December 2001, the Argentine government froze every bank account in the country. Overnight, your $40,000 became inaccessible. Not gone, not stolen, just locked behind a door that the government now controlled. They called it the corralito, the little fence. The fence went up in a single weekend. But the cracks that caused it had been spreading for nearly a decade, quietly, invisibly, while everyone was told everything was fine. That is what this video is about. Not the collapse itself, the moment before it, the quiet period, the period when the data looks almost normal, when most people are still going about their lives, when the warnings are there, but only visible to those who know what to look for. History shows us again and again that economies do not break without warning. They break after a long series of ignored warnings. And the people who survive them, who actually come through these periods in a better position than where they started, are nearly always the people who understood what was happening a little earlier than everyone else. Before we go further, there's something important to understand. Most people think of economic collapse the way they think of a car crash, sudden, unexpected, a screeching of brakes and then silence. But that is almost never how it actually works. A more accurate metaphor is a building with termites. The building looks fine from the outside. The paint is fresh, the lobby is clean, the people inside go about their day completely unaware. But deep inside the structure, in places no one is looking, the wood is being hollowed out, slowly, methodically, and by the time you see the first crack appear in the wall, the structural damage is already severe. The visible crack is not the beginning. It is the announcement that the beginning happened a long time ago. The mechanism behind this, the reason economies move toward collapse slowly and then suddenly, comes down to what economists call systemic fragility. That is a fancy phrase that means the system has quietly become unable to absorb shocks that it used to handle easily. Think of it this way. A healthy system is like a tree with deep roots. A strong wind comes along and the tree bends, it sways, but it holds. A fragile system, one that has been hollowed out by debt, by bad decisions, by hidden losses, by misaligned incentives, is like that same tree with rotted roots. It looks identical on the surface. The leaves are green. The bark looks solid. But when the same wind hits, it does not sway, it snaps. And the people who were sitting underneath it never saw it coming because they were looking at the leaves, not the roots. What makes the pre-collapse period so dangerous is precisely that it looks so normal. In fact, history shows that the final years before a major economic break are often periods of unusual optimism. The stock market is rising, unemployment is low, restaurants are full, real estate prices keep climbing, banks are reporting record profits, and underneath all of that, the roots are rotting. This brings us directly to the first case study, Japan, 1989. In 1989, Japan was considered the economic miracle of the 20th century. Japanese companies owned skyscrapers in Manhattan. Japanese banks were the largest on earth by asset size. The Nikkei stock index, that is Japan's version of the Dow Jones, the main measure of how Japanese companies are valued, had risen from roughly 6,000 points in 1980 to nearly 39,000 points by December 1989. That is a 6.5-fold increase in less than 10 years. Japanese real estate had become the most expensive in the world. At the peak of the bubble, the land beneath the Imperial Palace in Tokyo was theoretically worth more than all the real estate in California combined. Not more than some of California, all of it. Ordinary Japanese citizens felt wealthy. They were wealthy on paper. A salaryman, that is what Japanese workers in large corporations were called, who had bought an apartment in Tokyo in 1980 had watched its value multiply 3, 4, 5 times. Banks were lending money freely. Companies were borrowing and investing. The mood was one of permanent descent. Japan's Ministry of Finance had published reports suggesting the country would surpass the United States economically within a generation. But here is what was actually happening beneath the surface. Japanese banks had been lending enormous amounts of money against real estate as collateral. Collateral means something of value that you promise to hand over if you cannot repay a loan. As property prices rose, banks felt safe lending more and more. Borrowers used those loans to buy more property, which drove prices up further, which made banks feel even safer, which led to more lending. This is called an asset price bubble. A bubble is when the price of something disconnects from its actual usefulness and is driven instead purely by the expectation that it will keep rising. Everyone buys, not because the thing is worth that price, but because they believe someone else will pay even more for it later. On the 29th of December 1989, the Nikkei peaked at 38,116 points. Then it began to fall. By 1992, it had lost nearly 60% of its value. Japanese real estate prices fell for 14 consecutive years. Some properties lost 80% of their value. Banks that had lent against those properties were suddenly holding loans that were worth far more than the collateral backing them. Those banks were effectively bankrupt. They owed more than they owned, but they kept functioning, kept rolling over bad loans, kept hiding the scale of the problem from regulators and from the public. Japan entered what historians now call the lost decade, though it stretched into 2 decades. Economic growth ground to a halt. Unemployment climbed. The generation that entered the workforce in the 1990s never recovered the career trajectories their parents had enjoyed. And all of it, every year of stagnation, can be traced back to the decisions made during the years when everything seemed to be going perfectly. Here is something I want you to think about before we go further. If you had been living in Tokyo in 1988, surrounded by rising prices, and newspaper headlines celebrating Japan's economic dominance, would you have believed someone who told you the whole thing was a house of cards? Drop your answer in the comments. Seriously. Because what I'm about to show you next is the part of this story that most people never hear. And it changes everything. Because Japan is just one example. The pattern that destroyed Japan's economy was already ancient by 1989. It had already played out in full just 6 decades earlier in a country far less stable, with consequences far more severe. This leads us to the second part of this story, Weimar Germany, 1921 to 1923. Germany after the First World War was a broken country. The Treaty of Versailles, the peace agreement that ended the war in 1919, had forced Germany to pay massive war reparations. That means the country was ordered to pay money to the countries it had fought against as compensation for the damage caused by the war. These payments were enormous. Estimates suggest Germany was asked to pay the equivalent of what some historians calculate as several $100 billion in today's money. The German economy could not generate that much through normal taxation. So the government, at first, the printing was modest. Prices rose gradually. A loaf of bread that cost a few Pfennig in 1919 might have cost a few more by 1920. Uncomfortable, but manageable. The mechanism was not yet visible to most ordinary Germans. Some even welcomed the slightly loose monetary policy because it made German exports cheaper and kept unemployment lower than in neighboring countries. The economy appeared to be recovering. New businesses were opening. The streets of Berlin were busy. People were spending. But the money printing accelerated, and then it accelerated again. The government's debts were denominated, meaning they were measured and owed in foreign currencies, which Germany could not print. So they printed more marks to buy foreign currency, which drove the mark's value down, which meant they needed even more marks to buy the same amount of foreign currency. The spiral became self-reinforcing. By 1922, the German mark was losing value so fast that workers demanded to be paid twice a day, not twice a week, twice a day, because by the afternoon, the money they had earned in the morning was already worth less than when they received it. Women would stand at the factory gate at noon with wheelbarrows to collect their husbands' wages and run immediately to the market to buy food before prices rose again. A man's life savings from 40 years of work could, by November 1923, be insufficient to buy a single newspaper. One egg cost 4 billion marks at the peak of the hyperinflation. One egg, 4 billion marks. The official peak of the crisis came in November 1923, when the exchange rate reached 4.2 trillion marks to one United States dollar. But here's the part that rarely makes it into textbooks. The hyperinflation of 1923 did not appear from nowhere in 1923. The German central bank, the Reichsbank, had been expanding the money supply steadily since 1919. The warning signs were measurable, quantifiable, visible to anyone who looked. Economists who understood monetary theory had been writing warnings for years, but the government dismissed them. The public did not believe it could get that bad. And the people in power had short-term political incentives. Printing money kept unemployment low and kept people calm just long enough to get through the next election cycle. The rot was in the beams, not on the surface. The building looked occupied and functional all the way until the moment the floor fell through. Now, here's where it gets interesting. Because if Weimar Germany and Japan represent two very different kinds of pre-collapse conditions, the third case study reveals something even more fundamental. Something that shows the pattern operates not just in countries with obvious political problems or obvious economic mismanagement, but in the most sophisticated, most regulated, most closely watched financial system in human history, the United States, 2004 to 2008. Most people know the story of the 2008 financial crisis, but most people know the wrong version of it. They think it was a story about greedy bankers making bad bets. That is part of it. But the more important story, the one that explains why it happened and why it was so devastating, is about what was happening in the years before 2008, when the data still looked fine. Between 2001 and 2006, the United States housing market went through the most rapid expansion in its history. House prices nationally rose by roughly 85% over 5 years. In cities like Miami, Las Vegas, and Phoenix, prices more than doubled. Banks were issuing mortgages, loans to buy homes, to people with almost no verification of income or employment. These were called ninja loans. No income, no job, no assets. Lenders did not care if the borrower could repay the loan because they were not planning to hold the loan. They sold it to investment banks, who bundled thousands of these loans together into complex financial instruments, financial products, that were then sold to pension funds, foreign banks, and insurance companies around the world. The rating agencies, companies that are paid to assess how risky a financial product is, were giving these bundles of terrible loans their highest safety ratings, AAA, the same rating given to United States government bonds, the safest possible rating. By 2006, the total value of these mortgage-backed securities, packages of mortgages sold to investors, exceeded $9 trillion. $9 trillion of instruments whose underlying value depended on the assumption that American house prices would never fall significantly on a national level. Here is a specific number that tells the whole story. In 2006, the delinquency rate on subprime mortgages, that means the percentage of high-risk borrowers who were already behind on their payments, began rising. It was a small rise, from roughly 5% to around 6 or 7%. Almost nobody at the senior levels of the major banks noticed, or those who noticed chose not to act. The model that priced these products had never been tested in an environment where house prices fell nationally. The model, mathematically, said it could not happen. And so the people in charge kept doing what they were doing, and the floor kept looking solid, and the termites kept working. By September 2008, Lehman Brothers, one of the oldest and largest investment banks in the world, had filed for bankruptcy. It was the largest corporate bankruptcy in American history. Within weeks, the global credit system, the system of loans and trust that allows businesses to function day to day, had effectively seized up. The United States government committed over $700 billion in the initial rescue package. Estimates of the total cost of the crisis, including lost economic output, jobs, and savings, range from $5 to $15 trillion. The damage to ordinary American households, to retirement accounts, to home equity, to employment, took years to recover, and for many families in the lower and middle economic brackets, never fully did. Most people will never know what you now know. Most people will look at these three events, Japan, 1989, Weimar Germany, 1923, America, 2008, and see three separate disasters caused by three separate sets of circumstances. If you are still here, you're starting to see something different. Hit subscribe. Because the next section is the part this channel was made for, the part they never put in textbooks, the moment where three stories become one story. Now observe what all of these cases have in common. In Japan, there was an asset price bubble driven by cheap credit, soaring property values, and bank lending that assumed prices would keep rising forever. In Weimar Germany, there was a debt crisis managed by printing money, which initially looked like recovery, but was actually the beginning of a catastrophic devaluation of the currency. In the United States, in 2006 and 2007, there was a credit bubble driven by financial innovation that had disconnected risk from consequence, meaning the people making risky loans were not the ones who would suffer if the loans went bad. Three different countries, three different eras, three different mechanisms on the surface, but underneath, the same mechanism every time. Debt was the accelerant, not debt itself, because debt is a normal and useful part of any economy. The problem was hidden debt. Debt that the system did not fully understand. Debt that existed in forms that made it invisible to regulators, to investors, to governments, to ordinary people going about their lives. In Japan, the hidden debt was the true scale of bank losses on real estate. Losses that banks knew about but concealed for years. In Germany, the hidden debt was the reparation burden that could never realistically be repaid from genuine economic output and would therefore eventually be monetized, paid through money printing. In the United States, The hidden debt was spread across $9 trillion of mortgage securities that were mispriced because the risk models used to price them were built on false assumptions. The same mechanism, different countries, different decades, same result. There's a second element that appears in every single case. This is the social element, and it is the one that makes these events so devastating to ordinary people. In every case, the period directly before the break was a period of unusually high public confidence. People felt good, markets were rising, or at least they were not obviously falling. The standard of living of most people felt stable or even improving, and this confidence was not irrational. It was based on the real data that was visible. The problem was the data that was invisible. The rot in the beams is invisible by nature. If it were visible, it would not be rot. It would just be a crack, and people know to fix cracks. A third element present in every case is what I would call the delay mechanism. The system has built-in delays between the cause and the consequence. A loan goes bad today, but does not show up as a bank loss until the borrower has missed several payments, which takes months. A currency loses real value today, but the effect on prices at the market takes weeks or months to fully register. A bubble reaches its peak today, but the properties of the system mean it can continue inflating for months or even years before it bursts. These delays create a window in which people who understand what is happening can prepare, while the majority, relying on the visible data, see nothing to worry about. At this point, the pattern becomes impossible to ignore. Now, this brings us directly to the human cost. Because the numbers, the trillions lost, the percentage points of economic decline, are abstractions. They need to be made real. And the way to make them real is to look at who bears the cost when these systems finally crack. The historical record is brutally consistent on this point. The people who suffer the most are almost never the people who created the conditions that led to the collapse. Those groups, the bank executives, the political insiders, the large institutional investors with sophisticated financial teams, have both the information and the tools to protect themselves. Often they have already begun doing so before the general public has any idea what is happening. In Argentina's 2001 crisis, the Corralito, the bank freeze, affected ordinary depositors, the middle class, teachers, engineers, small business owners, pensioners, people who had done exactly what they were told to do, kept their savings in the bank, trusted the financial system, followed the rules. Their money was trapped. Meanwhile, in the weeks before the freeze was officially implemented, Argentine banks experienced a significant withdrawal of funds by larger, more sophisticated depositors. Estimates suggest that in the 3 months before the freeze, capital outflows from Argentina accelerated dramatically, with well-connected financial institutions and wealthy individuals moving their assets out of the country and out of the banking system entirely. The ordinary depositor did not know to do that. They had no information that suggested they should. In Weimar Germany, the hyperinflation effectively wiped out the savings of the middle class. A retired civil servant who had saved diligently for 40 years found that his pension and his savings combined could no longer purchase a week's groceries. The wealthy, by contrast, those who held tangible assets, who owned farms, forests, factories, or who held assets in foreign currencies, weathered the hyperinflation relatively intact. In some cases, they even benefited because their debts, which were denominated in marks, became essentially worthless as the currency collapsed. They owed millions of marks that they could now repay with a handful of gold coins. In the United States, in 2008, the Federal Reserve and the Treasury acted swiftly to rescue the major financial institutions. The argument was that these institutions were too large and too interconnected to be allowed to fail. Their collapse would have caused a total seizure of the credit system that would have devastated everyone. That argument had merit, but the practical result was that the institutions whose risky decisions had created the crisis were largely made whole by public funds, while the consequences for ordinary Americans, job losses, foreclosures, destroyed retirement accounts, played out over years without equivalent rescue. Between 2007 and 2010, American household net worth, the total value of everything ordinary families owned minus what they owed, fell by approximately $13 trillion. For families in the bottom half of the wealth distribution, the losses were proportionally the most severe and the recovery the slowest. The pattern of who gets hurt and who escapes is not random. It is structural. It follows from who has access to information, who has liquid and movable assets, and who has the sophistication to understand what is happening before the mainstream narrative catches up to reality. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. Now, let us turn to the historical record of what people who came through these events with their financial stability intact tended to have in common. This is not financial advice. Every individual situation is different, What I am describing is a pattern observed across multiple historical crises, drawn from the academic and journalistic records of those events. The first characteristic is what the historical record consistently describes as early awareness, not prediction. No one can reliably predict the precise timing or trigger of an economic break, but a willingness to pay attention to the underlying conditions rather than the surface indicators. The people who navigated the Weimar hyperinflation with the least damage were not necessarily the wealthiest or the best connected. Some were farmers and tradespeople who, when they began to notice that prices were rising month after month, made the simple decision to convert their savings into tangible goods, flour, tools, materials, rather than hold marks in a savings account. They did not know exactly when the hyperinflation would peak, but they recognized that the direction of travel was dangerous and adjusted accordingly. The second characteristic is what historians describe as asset flexibility. The people who suffered most in every major economic break were those whose wealth was locked into a single system, a single currency, a single institution. The Argentine engineer with $40,000 in a local bank had no flexibility when the Corralito descended. The Japanese salaryman whose entire wealth was tied to the value of his Tokyo apartment had no flexibility when property prices fell for 14 years. The American family whose entire retirement was in a 401k, invested in bank stocks in 2008, had no flexibility when those stocks lost 60 or 70% of their value in a matter of months. The historical record shows that those who came through these periods had assets in multiple forms, or had at least some portion of their savings outside the primary system that was under stress. The third characteristic is what I would describe as delayed panic. The historical record shows a pattern that is deeply counterintuitive. People who made dramatic, last-minute, emotionally driven decisions in response to a crisis consistently did worse than people who had made quieter, less urgent preparations earlier. In 2008, investors who sold their stock holdings in panic at the bottom of the market in March 2009 locked in their losses and missed the subsequent recovery. People who bought real estate in Argentina just before the Corralito, reasoning that property was safer than cash in a bank, found that the crisis froze all transactions anyway. The most effective adjustments documented in the historical record are those made gradually, early, and without the urgency of panic, because panic compresses your options and destroys your judgment. Now we return to Buenos Aires, to our engineer on Avenida Corrientes. He did not move his money in time. Most people did not. When the Corralito came down on the 3rd of December 2001, his $40,000 became inaccessible. Over the following months, the Argentine government implemented a forced conversion of dollar-denominated accounts into pesos at a rate of 1-to-1, even though the real market exchange rate had moved to roughly 3 pesos per dollar. His $40,000 became effectively $13,000 in purchasing power, a loss of roughly 2/3 of his savings with no warning and no recourse. His daughter did not study medicine that year. She enrolled 3 years later, once the family had slowly rebuilt. Argentina defaulted on approximately $100 billion of sovereign debt, money owed by the government to creditors, in December 2001. It was the largest sovereign debt default in history at that time, but the conditions that made it inevitable had been building since at least 1991, when the country fixed its currency to the dollar in a system called convertibility. For 10 years, that system held prices stable and brought investment into the country, but it also made the economy rigid, unable to adjust to shocks, and it required the government to keep borrowing in dollars that it could not print. When the shocks came, and when the borrowing became unsustainable, there was only one way out, and the people who had no warning, no information, and no flexibility bore the full cost of a decision they had no part in making. The lesson of Argentina 2001, and of Japan 1989, and of Weimar Germany 1923, and of the United States 2008, is not that you should live in fear. The lesson is that these events follow identifiable patterns. They are not random. They are not acts of nature. They are the consequences of specific decisions, specific structures, and specific dynamics that accumulate over time in ways that are visible if you know what to look for. The warning signs are almost always present. The question is whether the people who see them have the information to recognize them, and whether they have built enough flexibility into their lives to respond. Economic breaks are not lightning strikes. They are slow rivers changing course. The river moves a little to the left each year. The land it crosses looks the same, but over a decade, the river is no longer where you thought it was. And the towns that built their futures on the old course find themselves suddenly dry. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified professional before making any financial decision. This video is not for everyone. Most people will dismiss it. But if one person in your life needs to hear this, share it with them. Not because it will change the world. Subscribe for more, and I will see you in the next one.